Start off with the yen. We're going to have a look and talk about it both fundamentally and technically. We're then going to move on to the US dollar and the impact of the Fed minutes. We're going to then move on to the Aussie dollar and talk about just briefly about rate cuts and where the central bank are, and then have a look at the market. And then we're going to talk about gold's little epic failure and the trap that was set out for the bulls on Monday. We're going to move on to the euro dollar and oil and just talk about how in terms of patterns and fundamentally they're very, very similar markets. So you could lean on one or the other to almost trade the other. And then we're going to just quickly revisit the CAD, talk about that trade we've been focusing on for the last 3 weeks and see how that's playing out. So let's get straight into it and talk about the yen. Now the first thing I want to post is effectively we got this article in the FT on Wednesday. And the reason I posted this and why I want to talk about it is because what they're in essence talking about is how the yen's been so locked up for so long, and a lot of bankers were almost talking that the minute we get this breakout, we should start to see a continuation of the weaker yen. Now, the reason I like pointing out these things is that a lot of these guys talk their book when they talk into the big newspapers and all that. So it's so important to read and interpret. What are the big players in the markets? What are their positions effectively? Because if all of a sudden the market starts to go against those positions, we can get some really good unwind trades. Now, the second piece of fundamental news I wanted to flag up this morning was in the FT this morning, and it was all about obviously the Bank of Japan had their meeting and today, and what they were effectively saying was that the Bank of Japan tweaked their language somewhat to signal growing confidence in the strength of the economy. Now, very important, I just want to go through the highlights of that article, but what they were saying was that it's very unlikely that they're going to expand QE right now or in the June, July months ahead, and that there was a stabilization in consumption expenditure and residential investment, and then more importantly was the quotes that we got from, again, these bigger institutions talking their books. And what we got was the same feeling of, and this is a direct quote at the bottom here, but they were saying, however, we remain convinced that prolonged below target inflation will cause further QE. So again, we've seen two articles both on Wednesday and on Friday now where people are saying, well, you know what, it doesn't matter that the Bank of Japan's coming out, that the members are coming out and sort of saying to us that inflation will return back to 2% early 2016. It doesn't matter that they're saying the economy is starting to grow correctly, because at the end of the day, the market is saying we do not believe the central bank, therefore we will hold short positions in the yen. Now, why I want to point this out particularly is because both technically and fundamentally something's building. Now, what do I mean by that? Fundamentally, it's simple, okay? We've seen this situation of a lack of belief in central banks, not just from the Federal Reserve, not just from the Bank of England, not just from the ECB, but now it's the Bank of Japan too. And the implications thereof is, you just take for example, Mario Draghi's came out all year saying there is sufficient supply in the bond markets and that there isn't, there's going to be enough bonds to buy, and the market didn't believe him for a long, long time. The market didn't believe the growth story in Europe, and all of a sudden, one day, someone woke up and the bond market's corrected. Now, I'm not saying the yen's going to correct. What I am saying, however, is that fundamentally there is a case for a very strong reversal if people start to believe that the Bank of Japan or that the Japanese economy is actually starting to show green shoots again. Now, let's move on technically, because this is where the interesting play comes in. Now, the first chart I'm going to look at is the yen. Now, we spoke, and I'm just going to get up this is effectively the futures chart. Now, why I want to talk about this particular is because what we effectively saw on Tuesday was we saw this little bit of a breakout. So as you can see, there was, it's the first time we've kind of posted three sort of red candles that open at the high and close at the low, open the high, close the low, open the high, close the low. Now, technically, we've not seen that sort of price action since sort of middle of March, even maybe this sort of point here, so middle of March. Now, what I want to emphasize is that price action or that direct response from the market, okay, was accompanied by a slight pickup in volume. However, and this is the clue, this is where the market's talking to us, okay, there is a price response, but let's do a relative analysis and compare this break to the previous month. So compare October, November, December, January, and have a look at the volatility with the volume. Now, as you can see, if you look at this grey line, that's effectively a 10-day moving average of volume. Now, back in sort of the the latter end of last year, early this year, we were doing 200,000 contracts a day in the yen market. At the moment, presently, we're doing 100,000. So we're doing 50% of the volume that we were doing, not even that long ago. So very important. The first thing is that, whilst the break was accompanied by a slight pickup in volume, it's not convincing. It's not telling me, it's not screaming to me, there's a big trend coming in. Now, that's the first thing I want to point out. Second thing I want to point out, there are clear lines in the sand here, guys. If this market now is going to resume this downtrend, and we're going to continue with yen weakness, and the market's going to continue this belief of more QE, then we've got to take out these lower areas very, very early next week. Otherwise, as you've seen with this drop off in volume, if we get back above this sort of area where we broke out that double bottom area, where it's sort of acted as support 1, twice, 3, 4 times, but also acted as a volume pickup point, we get back above that sort of 83.20 area, and we could see not just a very aggressive unwind trade, but at least, maybe even a potential turnaround in the Japanese yen, and start to see the yen actually start to see maybe traders say, well, hang on a sec, maybe this yen isn't that weak, maybe fundamentally something else is at play in this market. So keep an eye on the yen. It is a market we're keeping an eye on simply because it's moved this week, it's come alive again. So that's the Japanese yen. Let's then move a little bit further on. Let's talk about US dollar and the Federal Reserve. Now, we had the FOMC come out on Wednesday, and just one thing I want to point out, so important, guys, it was a relative non-event. There was nothing really significant that stood out, but there was one line that kind of caught the market's attention, and it was this sort of headline. The key question now confronting the Fed is how much of the current slowdown, in other words, the Q1 slowdown, how much is that due to the port strike and the bad weather? And whether or not is this still a short-term thing, or is this actually maybe a longer-term trend that's developing? And it's so important that US traders go and interpret that for yourself, because if this is a longer-term thing, if the US is not going to hike rates this year and probably only next year, as the market's pricing in the bonds at the moment, okay, then that's posing a significant opportunity for us as traders. Now I'm going to show you where that opportunity is, and hopefully we can continue this talk over the weeks ahead. Now, what I'm going to bring up here effectively is the dollar index, and what I want to point out is two simple things. Okay, one, we've had this very aggressive trend which we've been talking about for a long time. Okay, that trend was created on the belief that the Fed was going to be hiking in 2015. Okay, the markets were very aggressively, when this trend started back in sort of, the middle of last year, it was on the belief that, tapering's coming to an end, it's now time for the Fed to lift off and start hiking rates. But more importantly, hike rates ahead of every other central bank. Okay, now what I do want to point out is, all of a sudden, if the Fed's starting to, question whether or not this slowdown is a short-term or a long-term effect, okay, the bond markets are correctly priced. The equity markets, well, they'll keep finding a bit, on this sort of stimulus, type measure where the Fed remains accommodative for even longer. But the dollar is far ahead of any other market in terms of, dollar is effectively saying the Fed's going to hike rates soon. Okay, so what I would say, if you're a dollar bull, excellent, right trade, stick with the trend, it is still a bull market. However, just understand that it's only a bull market so long as buyers are willing to hold. Now, two things I want to point out. In terms of a correction type move, we have had a very shallow pullback. We haven't really had a significant pullback. Now, fundamentally, if we continue to see weakness in the US data, I'd expect this pullback to be a little bit deeper. Maybe the 38.2, maybe the 50%, and maybe even all the way back towards this breakout point. Now, I'm not saying that's my base case scenario. What I am saying, however, is that this is still a very long market. If it's very long, it doesn't take a great deal for the longs to start to panic. So keep an eye on that dollar. More importantly, make sure you're watching the dollar and what the implications are for the other currency markets. Let's then move on and talk about the Aussie dollar. Now, the first chart I want to bring up is just very briefly, I want to talk about the Aussie dollar rate cut cycle. Now, effectively what you got here is the, how the Aussie dollar in the orange line has, how the central banks responded over the last couple of years. And what we can see is from a height of sort of, 4.5%, we saw the Australian, central bank cut rates all the way to about 2%. And recently, at the start of this year, we've had another further 2 rate cuts from 2.5% to 2%. Now, what I want to point out effectively, if you watch the currency and the top part here is the Aussie against the US dollar, what you can see effectively is as the Australian central banks cut rates, initially the Australian dollar stayed very strong, and that was a result of effectively China and the continued boom in China and the demand for Australian yield, as yields were much higher in Australia than any other AAA rated country. What eventually happened is the Australian dollar on a relative terms, when we got to that 2.5%, effectively they were no longer one of the major yield offering opportunities, and of course we started to have the slowdown in demand for commodities. and the result was we saw that sort of, the Australian dollar move all the way from above parity all the way down to a low of 78 cents. Now, the reason I want to point out this chart is simple, is we've had a further 2 rate cuts, and yet price has actually gone the other way. Now, it's so important to understand that, because effectively that's what bottoms are built on, guys. If strong fundamentals that should make a market go one way but actually go the other way, okay, that starts to not necessarily talk about bang, go long Aussie dollar now, but that starts to talk of maybe a little bit of a bottom starting to form in the Australian dollar currency. Just keep an eye on it. It's just something I wanted to talk about in terms of the Australian dollar and where rate cuts are. What I would say from a fundamental perspective, okay, the RBA Stevens has come out and he said to us that right now they're not closing the door on their language and interpretation in terms of further cuts, okay. But if he were to come out eventually and say, well, you know what, we see this as being the floor in the the Australian dollar, I would be very, very aggressively looking to get long this Australian dollar, just simply because how it's been responding over the last couple of months whilst interest rates are being cut further. So keep an eye on that, just something to pay attention to in the weeks and months ahead. Let's then turn our attention to the gold epic failure. Excellent epic trap here. I'm going to show you what a trap looks like. I'm going to show you how much fun it is when people get trapped, but more importantly, I'm going to show you where to make money on these traps. So very briefly, we spoke about gold last week, and we spoke about the significance of this 1223. We said how if the market can close a confirmation close above 1223, we should see a continued up move. Now, what happened was we got that confirmation close. If I was to just point out this green candle here, that's the confirmation close. The market closed above there. However, note, volume was not confirming anything to me, okay? It was well below average, the volume on the confirmation close. So that was my first little clue that, something doesn't smell right here. Not only did we have a sort of a sharp rejection from 32s as the dollar was rebounding, but the volumes were particular. There was no commitment. However, we still had to stick with the trend initially. But the trap was laid, the low volume trap was laid, and once we took out this previous day's low, in other words this area here, if I was to just point this out, once we took out that sort of 1221 area, note that what we got the next day. We got a full-bodied candle close from $25 to almost a $20 move. So let's quickly scale in and just have a look how this trap was set, and more importantly, where we could have got involved. So the first little candle here is the confirmation close. That's the market saying, you know what, hang on a sec, we want to be above this key little area, 1223, and strong close. The market then sort of came in the next day and drifted. A lot of sideways action, and eventually on the break of this 1216 area, the market had a very aggressive move. Now note the volumes, guys, very important. The trap will effectively get people long, and once we take out a key area, the longs will liquidate. More importantly, when you get a long liquidation or a trap, okay guys, it's not a one-off thing. It's not going to just do it for one 60-minute candle and stop. It's going to continue, okay, because there's a lot of longs caught in the same position. And you can see, we had another aggressive, 30,000 contracts in an hour sell off later on in the day from 12.15 all the way to 12.05. So go and add that to your playbook. Add traps into your playbooks. They're wonderful opportunities to make good money. More importantly, where was our entry? Well, it's simple. Okay, note we had the response point there. When we broke below that 12.16 response point, the volume picked up and we came back, retested, and sold off. So that's a very simple trap. Go and have a look at it and add it to your playbook for next time. Let's then move on to the oil and euro dollar, and I want to just explain to you what I mean by the market looking very similar. Now, the reason I say this, in fact, I'm just going to get a slightly different chart up here so we can see it a little bit easier, but the reason I want to talk about these two currency pairs is because both of them from a fundamental perspective have sold off very aggressively in over the course of 2014 and early this year. Reasons being obviously vary, fundamentally supply and demand in the oil, whereas the interest rate divergence and QE in Europe. Now, two things I want to illustrate, and one is effectively we're in a firm downtrend in both markets, okay? Effectively we've bounced now in both markets, and more importantly, effectively we've left a low volume area, and I've been talking about this. We've left this area of no trade from 110 to 111 effectively. The market hasn't traded there. Okay, now I've been talking about this anomaly and saying how it's unusual for that not to be traded. I've also been saying how we've had very shallow pullbacks in the euro and the oil. So one or two things I just want to point out. If we were to see the dollar start to weaken again, right, don't be surprised if we start to see this euro very quickly unwind and get back above these 114.71 area, okay? But what I want to illustrate here was effectively when you have strong downtrends, Okay, the first pullback area is, you know, the point where you want to get very aggressively involved. Okay, whether or not this is the first pullback will be, you know, take time to be seen. But what I would say, if we take out this week's low next week, don't be surprised to see a little bit of a continuation move to this 108 area before bouncing and then starting to accept area between 108 and 112. Now, a similar type of chart I'm just going to quickly show it to you is the oil chart, and let me just quickly get this chart up. So this is the oil chart. Oh, go on there. Okay, so there's the oil. Okay, again a very similar, you know, chart pattern where it's sold off very aggressively. We've had the sort of the bounce. Okay, but again, look in this area where I've got this purple box between this sort of $54 a barrel and $55 a barrel. The market just hasn't traded there. It's not accepted that price. Now, again, it's not to say that oil is going to turn around and come down now. But what I would say is that when oil turns, I will be looking not just for the market to navigate its way back here, but to sort of almost go beyond that and then start to fill out and accept value. And it's important you understand that, guys, because you can develop a very strong strategy for once we get back down and turn, you effectively start to buy low and sell high and just let the market fill out this area and just fill in that range over the course of days, weeks and months. So that's the oil and the euro. It's a pattern I've been talking about. We're going to keep a close eye on that, and hopefully we can all make some good money on that. Then the last thing I'm going to talk about is the Canadian dollar, just very briefly. We've been talking about how the Canadian dollar has been the weakest little guinea pig against the US dollar, and how price action has been showing us something very, very interesting, which is a lack of commitment to the downside. Now, we've spoken for the last 3 weeks and said how these little long legs, these long legs talk to us and they tell us that market does not want to hold lower prices. Now, we spoke and we said how this 121.43 was the key. We get above there and we should start to see this market navigate back towards the high and form a flag in an uptrending market. So what I do want to just point out is, for me personally, it looks very obvious, but 121.43, I will be looking to get long there early next week, and I will be looking to run this back up towards this 124.50 area. In terms of the downside, well, I don't particularly want to see the market hold strength below 121.43. I want to be buying into weakness now, and I don't want to see, you know, people selling into, you know, too aggressively, because that'll start to put that trade under pressure. To the downside, obviously, if we get below that 120, well, you know, those long legs are going to get tested again, and they're either going to hold or fail. So that's the Canadian dollar. That's pretty much, you know, a wrap up of what's important at the moment in the markets, and what's, you know, driving the commodities in the FX space. And I just want to finish off and, you know, just as I say every week, it's not about the money, guys. Rather, just it's about the process and the execution. So these ideas we give you, these opportunities we present you with, you know, they are just ideas. You as a trader have to go away, develop a strategy, a process, and ensure that you execute that to the best of your ability. And if you do, guys, you know, in the long run, you should be making good money. So be patient, don't compromise, wait for those opportunities to come, and, you know, just maximize your profit at the end of the day. Otherwise, have a good weekend, and we'll see you next week.